Good afternoon, good evening, good morning, wherever you are, whenever you are. Hello, thank you for watching my videos. It's Mike. Here's a few of the stories of the past week that you may not have watched or seen. Now the first one is from Ambrose Evans Pritchard. He's been rather busy this week. He had a couple of weeks off on holiday, so I guess he had to get back at it, really. And he had lots of things to think about. Now the first article, Credit Tightening Threatens Chinese Giant Ponzi Scheme. Basically saying that China has been stimulating their economy by giving out money directly from the government to companies, hopefully to pump things up. Well, yes, so loans have been dropping, the growth rate in loans has been dropping. Apparently a lot of the money has been going to casinos and things like that, not directly into business. So anyway, the bubble that China has been creating with their stimulus package is slowly coming to an end, which means more than likely things are going to go bang over in China to some extent, although of course it will not be reported. This is a communist country we're talking about. Separately, he says here, the Baltic Dry Index. Now, Ambrose really likes the Baltic Dry Index, but anyway, Baltic Dry Index has dropped 25% since late July. The Baltic Dry Index measures the bulk rate of freight for transferring goods, so things like commodities and grains and things like that. So this shipping has dropped dramatically, indicating that China has stopped buying up stocks of metals and other commodities after a spate of frantic buying. So they're slowed down their buying, they've stopped lending out quite so much money. The Shanghai index is being sucked back down, and things don't look very good. Now, the official Chinese GDP continues to grow near 8%, so says Ambrose. This is based on output, but of course, there's lots of capacity, and I have a further article from Ambrose later about worldwide capacity for production and output, but there is no demand. And Ambrose has rightly pointed out something I pointed out a few months ago. Who's going to buy this junk anyway? The Guardian had a story this week. Chinese Christmas exporters hit by global recession. Now, you may not be aware of this, but right now China is pumping out all kinds of little Santas and reindeers and all kinds of other weird and wonderful goodies for Christmas over here in the West. Well, nobody's buying it. Apparently the orders to the Chinese manufacturers of all of this is dropping dramatically. And they are not entirely sure if they're actually going to sell all this junk they're producing. Moving a little further. Now, Ambrose seems to have been dragged into a news story. France and Germany lead the West out of recession. Also linked over here, should you wish to read this. France and Germany became the first G7 powers to emerge from the Great Recession of 2008-2009, surprising markets with a growth of 0.3% in the second quarter. Now, he does go on to say lots of other things in here, basically saying that a lot of this seems to be coming from the Cash for Clunkers program that's been going on in France and Germany, and also recently started in the UK and of course over in the States. So it seems to be a little bubble in the economic downturn that probably can't continue for long. I mean, realistically, how many people can buy a new car every 6 months? So now, one of his other pieces here, Keynes rescues France and Germany Club Med lost. Now he goes on to talk further about this cash for clunker schemes, lifting France and Germany from the depths of recession, etc., 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 and then goes on to talk about John Maynard Keynes and what he has to do about it, and how the fact a lot of this is completely fake because of all the stimulus programs going on around the world. Germany and their various underhanded stimuluses, for instance, paying companies to keep people on who have no work to do. Things like that, and they can't keep that up forever. And also the other big one, of course, is quantitative easing, i.e. printing money, and that's carrying on. Now, one of the things he says in the bottom of one of these articles, he's talking about how the French... Actually, I gotta find it here. Oh, that particular line seems to have been removed from the article. The first article, France and Germany lead West out of recession. His first take of this had a really funny line at the bottom of his story about the French Minister of Finance basically coming off holiday and shouting out, "The recession is over, yippee yahoo!" And she is rather new to the French cabinet. Anyway, so the end of his story originally had the line along the lines of, she is also one of the members of, or a previous member of the French synchronized swimming team. I think he was having a laugh. Anyway, moving right along, in The Guardian as well, French shoppers skeptical of recovery. So France and Germany saying, yeah, everything's fine, everything's great, everything's we're on the uptick again, everything's going to be wonderful. I will try and link and find a couple of articles from a few weeks ago about how economic output from Germany spiked up in June and then dropped again, or rather it spiked up in May and then dropped again in June. And this is part of the whole, yeah, we're getting better nonsense. Anyway, so a couple of real people in Paris basically saying, I don't see how this could possibly be getting any better, and maybe France needs that psychologically. Perhaps it will boost morale and help us out of the economic mess. But we're on fragile ground. Let's just wait until autumn when unemployment goes through the roof. This is from Mr. Philippe Dupenier. Dupenier? Or I can't pronounce his name. Yeah, I'm sorry. He quit his job at the post office 12 years ago, set up his own communications business. Now he's back in Paris sorting letters after the crisis saw his turnover drop to zero and his business wind down. So a lot of businesses all over the place are collapsing, but they're probably not being publicized. They're all little, dinky little ones. Bradford Bingley post loss. Bradford Bingley is one of the big buy-to-let agencies in the UK. So they were giving out mortgages for stupid amounts of money for people to go out and buy to let, basically buy a house or an apartment to then rent it out. And of course the whole property market went completely mental, and now we're finding that a lot of these debts are turning bad and are not going to go very well. Also last week, the Council of Mortgage Lenders in the UK announced that there was a small decrease in the number of repossessions, but they fully expect the number of repossessions will expand dramatically over the next few months in the UK. Edward Conway, economics editor of The Telegraph, is also banging on about Europe and US still at risk from deflation trap. Basically saying that consumer price indexes are deflating. They have been deflating for the last 8 months. And there may be some truth to this. If consumers are lacking confidence, says Chris Rupke of Bank of Tokyo Mitsubishi, then they will not be able to help us spend our way out of this long and dark recession. Yes, the Great Recession of 2008-2009. Now, Ambrose, in a repeat of his further on his earlier column that I mentioned, there's no quick fix to the global economy's excess capacity. Basically comparing the amount of excess capacity in the world for producing stuff as compared to the amount of demand there is out there, and comparing this with what was happening in the late 20s leading up to the Great Depression. So all this nonsense about quantitative easing and pumping money into the economies, while it is making the decline not quite so bad, still not as good as it should be. And he goes on to mention deflation as well. CPI figures in Ireland down 5.9% on the year, Thailand 4.4%, Taiwan 2.3%, etc., etc. Even Canada comes in with a 0.3% decline in consumer price indexes, which would indicate that global prices are dipping. Now they will spike up again, particularly with food and so forth as they begin to inflate. But it's going to be a very bumpy ride downwards until we get rid of this excess capacity. The big news of the week, of course, was Friday. Now, every Friday, the FDIC, the Federal Deposit Insurance Corporation of the United States, comes out, and late Friday afternoon, after the markets close, and while everyone's heading home and before anybody really cares, they announce a few bank closures. Right now, we're running at a rate of about 4 to 5 bank closures per week. However, this week, we actually lost a publicly traded banking group. Colonial BancGroup becomes biggest bank failure of 2009. Now, this is the 78th bank to fail this year, in case you hadn't heard about this. However, they had $25 billion in assets, but their liquidity was completely blown out. They couldn't get any money to keep going. And now BB&T have agreed to step in and assume all of Colonial's deposits, and they're going to split the losses with the FDIC. Now the FDIC estimates that it's going to cost them $2.8 billion to keep the losses from going too bad. Now, it made it to mainstream press. It was actually in the Wall Street Journal, but of course, if you don't have a subscription, you can't read it. But I have linked here from the Financial Post in Canada a Bloomberg article. BB&T takes over Colonial after biggest U.S. failure since Washington Mutual. Now, one thing missing from this particular article is the fact that this is the 78th or 79th bank that has failed this year. I guess that's irrelevant. Yeah, whatever. So it's starting to ramp up now, coming up to the end of the summer, beginning of autumn. So we should see some more bank failures occurring shortly. Last piece. Ambrose Evans Pritchard. Now, he's been talking to the Royal Bank of Scotland's chief credit strategist, a chap named Bob Jangyung. Jangyung? I don't know. And he predicts a 3-month slide is coming. Basically, he predicts that somewhere around about September, October time, the stock markets are going to go and implode in a big way. Such a fall would take the FTSE 100, which is London's Financial Times stock exchange top 100, to around 2,500. He's also predicting S&P will fall to mid-500s. Doesn't go on to say what Dow Jones will do, but you can pretty much guess it's going to be crappy. And yeah, so if you want to understand where the markets are going and one of the more bearish predictors out there, take a look at the article. It's linked here from Ambrose Evans Pritchard, speaking to a chief strategist as to where the economy is going. This is all about wave theory and nonsense like that, but don't be surprised if late October, somewhere around there, things start going terribly wrong with the economy yet again. Okay, everyone. Peace, love, understanding. Think about things. Things are not always as they print. Okay, bye.